I'd like to welcome everyone to the Surplus Line Association of California's webinar on changes to state regulations and the effects on brokers and our surplus lines filings with our association. This presentation will cover the changes that will take place when NRRA goes into effect on July 21st, 2011. The webinar will be moderated by Hank Haldeman from the Sullivan Group and myself, Joy Irvin, the Director of the Surplus Line Association of California. We will be covering NRRA and AB 315. We will not, however, be covering AB 131.
Joy, we should note that SLA is conducting this webinar in its capacity as a trade association. This is not being provided on behalf of the California Department of Insurance, and it's not being provided by the SLA in its capacity as an advisory organization to the Department of Insurance. Again, we'd like to caution that the information not be considered legal or tax advice, and we do recommend that you all seek professional legal and tax advice on these important matters. The NRRA federal law passed last year and becomes effective in 2 days, July 21st. The elements that were passed in that law required that the various states conform their laws with the federal law, and California recently passed AB 315, and it was signed last Friday by the governor into law. AB 315 is the law that California uses to bring its laws in conformance with the NRRA. Today's seminar will focus on those changes and what they mean for California surplus line brokers. We are not going to go back into the history of the NRRA and what gave rise to it, but rather focus on what we need to do today.
So the basic outline of what we're going to cover during this webinar are listed on the slide. We're going to cover some of the things that are changes that are caused by this regulation, and some of the items that we're going to cover are brand new. We're going to review how you determine home state. We're also going to review how you determine an insurer's eligibility, and also the new eligibility requirements that have gone into effect. We will help you understand how you determine if an insured is a commercial insured, if this is going to make any changes to the way you do state tax filings and make your payments, and also any changes that will occur with your surplus lines filings with our office. And lastly, we will discuss the changes to the D1 and the D2. Hank, let's start with the home state definition, which is a major part of this new regulation.
Sure, Joy. The reason that the home state definition is so important is that with the NRRA and with the passage of AB 315, it is only the home state that regulates the surplus line transaction, and it is only to the home state that surplus line brokers pay tax, and we'll get into that in a bit. But obviously the most important thing as you get involved in a placement is to know at the outset what is the home state. And so we'll first touch base on that, and there's several things I will touch base on with respect to what is the home state. Whether it's a single state exposures, whether we're dealing with a business or individual, we need to discuss the principal place of business or principal residence, and at the end I'll touch on affiliated groups. First question you should ask is, are all the exposures in one state only? Because if they are, if all the exposures are in one state, it's a single state risk, and only the laws and regulations of that state apply. So the state of California, if your exposures are all in California, it's a California home-stated risk, and California's laws and what we talked about at AB 315 are what will apply. What's new, though, is that only one state can regulate a multi-state transaction, the home state. So let's talk about multi-state policies, and by that we mean policies where there are exposures in more than one state. The first thing that you need to do as a broker is to look at the risk you're placing and determine whether you're dealing with a business entity or an individual. If the insured is an individual, the home state is where the insured maintains his or her principal residence. On the other hand, if it's a business entity, the home state is where the insured maintains its principal place of business. In a moment, we'll discuss what is a principal place of business. First, though, we should note, if none of the risk insured, if there are no exposures located in the state where the insured maintains their principal place of business or their principal residence, then that is not the home state. Instead, the home state will be that state which has the greatest percentage of the insured's taxable premium for that particular placement. That means if the insured's principal place of business or principal residence is not in California, you will need to determine you'll need to look at the premium, the breakout in other states, and figure out where the greatest premium is, the greatest taxable premium, and that will be the home state. Just to emphasize, if any exposure is in, say, California in this case, 0.1% is in the same place as the principal place of business, then California is the home state, even if it's a tiny amount. The question of affiliated groups comes up, and first we should be clear what we're talking about with respect to affiliated groups. And that's only groups of entities that are affiliated, and we show on the slide what is a definition of an affiliate. Actually has to be entities that are related by control or under common control of the insured. As such, it does not apply to things like master policies and purchasing groups where the members of that group are not affiliated. In that situation where you have an affiliated group, if you have multiple insureds that are members of an affiliated group, as named insured on one policy, then the determination of the home state is based on the member, the insured, within that group that has the largest portion of the premium. It's a little different than we talked about a minute ago. It's not where the most premium is. You stop and have to break the policy down by insured and look at which of those affiliated insureds has the largest portion of the premium, and then go back to the home state rules and apply them to that particular insured, and that will be the home state. I'll talk for a minute about the definition of the principal place of business. It is in the Act, and we will also have it up on the website. But the key thing is that the principal place of business for a business risk is where the headquarters are of that company, as well as where the high-level officers of that company direct, control, and coordinate the business activities of the company. So both of those happening in one state, that is the principal place of business for that insured, and thus is the home state, assuming there's some exposure in that same state. But what if the headquarters is in one place and the principal officers are in another, or the principal officers are spread out amongst multiple states? You don't have a principal place of business by that definition. And if that is the case, then the home state becomes, you go back to the allocation of the premium. And the home state is where the greatest percentage of the premium is. So principal place of business works with those two things. Headquarters and principal officers are in one state. Now, you as brokers are required to maintain in your file the documentation of the basis on which you determine the home state. If it's based on principal residence and principal place of business, that's fairly simple. If you needed to go to one of the allocation reasons to determine where the home state was that we just discussed, your file should reflect on what basis you determined that the greatest amount of premium was in California that made it the home state. We'll move on to a second key provision of both the NRRA and AB 315, the California laws. And in background, the NRRA changed the way in which the states can control insurers who are eligible for use by surplus line brokers. Now, how California has implemented this is a little different. In the slide you're looking at, you see the basic eligibility criteria that federal law has now imposed. And I'm going to come back to that slide in a minute. The reason is that what California has done, as most of you know, we have up until this point in time had what we call RESLI, the list of eligible surplus line insurers. That's a list of insurers that has been reviewed in coordination with the Surplus Line Association by the department and then put on that list as eligible for use by surplus line brokers. Because federal law now preempts the eligibility requirements and brings a new standard, the department would like to continue to keep the buying public as well as surplus line brokers aware of the companies that they have reviewed, previously put on the Leslie list, and now will consider to be approved insurers. So they have taken the Leslie list and morphed it into the Lastly list, the list of approved surplus line insurers. And as of July 21st, all companies that are on Leslie will transfer and become members of Lastly. So they're automatically moved over, and then the requirements for staying on Lastly or getting onto Lastly as a new company are basically the same as they used to be for Leslie. Lastly is important because as a surplus line broker, you have the authorization from California to utilize any insurer that appears on Lastly. On top of that, there's at least some imprimatur that it's been, quote, approved, end quote, by the state of California Department of Insurance. Having said that, flip back a page. The federal law mandated that the states permit as eligible any insurers that fit into one of two groups and fit a certain set of criteria. Addressing number two there first. Alien insurers are those that are domiciled outside the United States. And the NAIC, the National Association of Insurance Commissioners, maintains a list that is called the Quarterly Listing of Alien Insurers, and it's maintained by the IID of the NAIC. Sorry for the alphabet soup there, but any insurer that appears on the NAIC's quarterly list, which they've basically reviewed, is eligible for use by California surplus line brokers for placement. In addition, dealing with the insurers that are in the United States but not licensed in California, we call those foreign insurers, there is a mandated standard for eligibility for them as well. And that standard is that they must be licensed in the United States state or domicile. They must be authorized to write the type of insurance in that domicile that you're planning to place with them in California, and they must maintain a minimum of $45 million in capital and surplus based upon the measurement of their state of domicile. Now, flip forward 2 slides, and we look at, so what happens if the insurer you want to use is not on Lastly? First, it's not shown in the slide. You can look and determine whether it's on the IID list. And although the IID list is available from the NAIC for a fee, it is not a generally published list. We're talking about how to make that list available to you as Surplus Line Association members, but I believe we will be able to field a call at the SLA where if you call in with the name of an alien insurer and say, is Company B on IID, the SLA will be able to say yes or no. And if they say yes, then that insurer is eligible. Alternatively, a U.S.-based insurer will be eligible But there is a requirement that the department have received documentation or evidence that they do meet those criteria that I just mentioned. And that is done by assuring that the insurer or yourself or another surplus line broker on your behalf or on behalf of the insurer has filed with the department the items that are listed on this slide. I'd encourage you to look back at this as you're determining that. I'm not going to read the individual items, but they're basically what's required to evidence that they are licensed in a state, they're licensed for the type of business, and that they have the capital and surplus as required. Moving on to the next item in the NRRA. The NRRA includes something called an exempt commercial purchaser. And that entity, an exempt commercial purchaser, according to the NRRA, is exempt from the diligent search requirements of any particular state. The way California has addressed this in AB 315 is with a slightly different name, commercial insured, as opposed to exempt commercial purchaser. If you hear discussions kind of on a multi-state or through associations and the like of exempt commercial purchasers, just think in California that's the commercial insured. And under the NRRA, a surplus line broker, a state cannot require a surplus line broker to perform a diligent search if the insured qualifies as, and I'm going to start using commercial insured for this discussion because we're talking about California law. And I should note at this point that doesn't override the exempt list, the export list, which remains in place. But to determine whether the insured meets the NRRA definition and the California definition of commercial insured, we've provided in the next slide a brief checklist. There are 3 requirements for a commercial insured. They must employ or retain a qualified risk manager. And qualified risk manager is something that is defined. It's defined in the California Code, which we've referenced down here. It's also the same definition, essentially, as exists in the NRRA. So you can look at either point for who is a qualified risk manager. That's one requirement. In addition, the insured must pay an aggregate nationwide property and casualty premium of at least $100,000 in the immediate preceding 12 months. In addition, remember you need to meet all 3 of these. In addition, they need to meet one requirement dealing with basically their size of operations. And those are listed on this slide. I'm not going to reread them, but they basically deal with the net worth and annual revenues required of a commercial insured. If the commercial insured meets all 3 of those criteria, then there are a couple things that have to be done in order for you to qualify for exemption from the diligent search. The first is that the surplus line broker, surplus line broker, must have initially disclosed in writing to that insured that the insurance that we're talking about may or may not have been available from the admitted market, and had it been available from the middle market, that may have provided a greater protection and greater regulatory oversight. I believe that we'll find the industry associations will start offering some very quick forms that can be used for this that include those provisions. Second thing is that the commercial insured must have, subsequent to that disclosure, have requested in writing that you, the surplus line broker, procure that insurance from a non-admitted insurer.
Thank you, Hank. When we talk about the commercial insured exemption, that brings us to the point where you will note that we have a variety of exemptions that are now in effect. And as a refresher, we're going to talk about a couple of the other exemptions that we have. So if you have a commercial insured and you've reviewed the requirements for that, you will not have to do a diligent search, and you will have to note to your file how you determined that and that you advised the insured about that. The second type of exemption that we have in effect is the industrial insured, not to be confused with the commercial insured exemption. The industrial insured, that has not changed, the definition of that, and you will note you still do not need a disclosure statement, a D1. The export list is still in effect. We still have a variety of coverages that are on that list. It's available on our website, and you do not need to conduct a diligence search for that as well. Now, there are a few types of insurance coverages that no SLA filing is needed. One is ocean marine, the other is aviation, and interstate transportation. So that exemption is still in effect. There's been no changes to that. There's also hasn't been a change to the gap coverage exemption when up to 20% of the risk for non-eligible insurers. So moving on to the state tax payments under AB 315, the effective date of the policy is going to be the date that everything will hinge on. Everything prior to 7/21/2011 will be governed by the pre-existing regulations and laws. Anything that is new or renewal that is effective after 7/21 will be governed by the new NRRA and AB 315 regulations and laws. So brokers may be required to provide the data on the premium allocation on multi-state policies on your March 1st premium tax filing, but that has not yet been determined. So brokers should be aware that if they have a multi-state policy, they should keep track of how the premium is allocated to the other states. And we'll get into that a little later when we talk about the tax filings and the surplus lines filings. But be aware that you should keep track of where your premium is allocated to if you have a multi-state filing. That being said, your California state tax is going to be paid on 100% of the premium, regardless if you have allocated premium to other states. 100% of all. Go ahead, Frank.
Just that 100% is all at the California rate as well, 3%.
That's correct. At 100% of the premium at the California rate will be taxed, and the stamping fee will apply to the entire premium as well. So the Commissioner has not ruled yet on whether they will be asking for the multi-state allocation data in the March 1st tax filing, and we will advise you when that does go into effect or if it will go into effect. And California has not joined any multi-state tax allocation agreements with other states, and again, we will be advising the members of our association if that does happen. And this is a good time to give you a screenshot of our homepage. On the homepage of the SLA website, up in the upper right-hand corner, you'll see a section that has your tax return information. That is where you will continue to find your documents to do your tax filing. And when NRRA goes into effect, on the homepage, you'll be able to find a reference point which will give you all the information that you will be looking for while you try to change the way you conduct your state taxes and filing with our association. You'll be able to hear this webinar again. You can print materials such as the memos we've issued or a copy of AB 315. You'll also be able to print an updated filing procedures manual. And please remember that you can always call or email the SLA for any help that you need in determining how you should apply these new rules and regulations. When we talk about how the effective date is the key deciding factor, we've given you two slides of examples of when a policy is effective and endorsements and how those are going to be affected. These are a variety of examples that give you a variety of dates. And they're just to get you thinking talking about when a policy is effective prior to NRRA, if an endorsement or cancellation is effective after, and then we actually come to a point where there is an additional date that becomes very important.
Sure, Joy. You note that October 18th, 2012 appears on a number of these examples. And that's significant because we have what amounts to a temporary transition period. And that transition period is there to deal with things like extensions to the policy and installments, things that will happen significantly after 12 months have passed since the implementation of the law. And so most annual policies will already have gone through their renewal. But there's a trickle of endorsements and or accounting details that may go on sometime after July 2012. October 18th, 2012 is a cutoff date for all of those. And basically any transactions, financial transactions and the like that happen after that October date will go under the new tax regime.
Great. Well, and the brokers do know that they can always call us if they are confused or they just want to make sure that they are applying it correctly. They can call us or email us, and we'd be happy to help them answer those questions. With the new regulations that are going into effect, the brokers should be advised that there is going to be a new D1 and D2. The SLA will continue to not need copies of these forms, that you are required to keep a copy in your own files, but you should start using the new D1 and D2 effective Thursday, July 21st. The D1 and D2 have been altered to reflect the word Lasley instead of Leslie, and a few other items. They're generally the same. They still have to be signed by the insured, and they still have to be issued with a policy, and they're available on our website. If you have any questions about the D1 and D2, even though we don't collect them, we are here to answer any questions you may have. It's a pretty straightforward change. Please start using the new D1 and D2 as of Thursday, and keep them in your file so you have them if you're ever audited. And now moving on to the very important part of this webinar, how is this going to change how you file with the association? One of the major changes for filing will be that you will be required to have a cover sheet when you send in a batch. The cover sheet will be mandatory, and if you don't send in a cover sheet, you will be tagged, and you will be asked to provide one. The reason for that is there are two pieces of information on that cover sheet that we are collecting. One of the things that we are collecting is whether that insured is a commercial insured. The other thing that we are collecting is if that policy is a multi-state policy. Here you'll see a cover sheet example. The thing to note is that we are not going to give hard, fast rules on how how you do the cover sheet within your own office. For example, you could do it in Word, you could do it in Excel, you could have your agency system print out a cover sheet, and that's not what we are concerned with. What we're concerned with is that the information that you see on the screen is what we are receiving with your batch. So we would like you to give us the date that you're submitting, the broker name, your broker number, and most importantly, on the far left, you'll see that we have you mark a box if it is a commercial insured, and we will be collecting that data within our database. And on the far right, you will see that we are asking for the percentage of the risk that's in California. That could be a little tricky, and so to make sure that everyone is clear, we're using that column to help us track what is a multi-state policy. If we see anything less than 100%, we know it's a multi-state policy. The premium that you're listing in the premium column is 100% of the premium, because if you have determined it's home state in California, that leads you to do the filing with the Surplus Line Association. So if you're filing with us, we are assuming that you've already determined it's home state with California. If you've already decided that it's home state with California, 100% of that premium should be taxed and have the stamping fee applied, and you're going to pay your state taxes and stamping fee based on that. So the California percentage on the far right is what is going to indicate to us that it is a multi-state or a single-state policy. For in the future, the state may require that you show the allocation to the other states. We are not asking you to do that at this time. We're just asking you to give us the percentage of the premium that is allocated in California. Well, to recap what we've discussed here, under the new NRRA and AB 315 regulations, there's some very important things, and we're going to try to make the outline of this as simple as possible. The first thing that you need to do when you are deciding to do your surplus lines filing is you need to make the decision of the home state of that insured, first and foremost. All other pieces of this puzzle fall together when you make that determination. When you have the home state and the home state that you've decided on will have exclusive authority to tax and regulate that surplus lines transaction. For the purposes of this webinar, we're strictly talking about how it applies in California. I strongly encourage everyone who does multi-state policies to review the requirements for the other states they might be required to do filings in. As of this time, we don't have any tax sharing compacts that are in place, and so we will advise you if those do come into effect. With 100% of the premium tax on the California home risk to be paid to California, also 100% of the stamping fee was paid to California as well, to our office. The other important piece here is that you need to know that the Leslie is now going to be called the Lasley. You can just interchange those words in your mind, and if you're reviewing them, the Lasley will be on our website. And if you have any questions about the eligibility of a carrier, you can always call and email us, and we will answer that question for you. The cover sheet, it's very important that you pass along this information to the folks in your office that do the filings with this office. They need to have a cover sheet, and on that cover sheet, they need to make sure they document if the insured is a commercial insured and if the insured is a multi-state risk. And finally, there is a new D1 and D2 that have gone into effect as of Thursday. Please make sure that you look on our website. When we switch it over to the new D1 and D2, we will be placing them on our website for you to print and to place in your files after you've had your insured sign them, or to put on policies when you mail them out. This concludes the webinar portion of this and informational, and now we're going to move into some of the questions that we received by email. A lot of you out there have emailed us some great questions that I think many of you would enjoy hearing the answer to. I'm going to turn it over to Hank so he can read some of the questions and some of the answers.
Okay. First question that was mailed in. Are surplus line rates for late filing fees, changing with this update? Other states have done that to handle administrative costs.
The SLA at this time does not have any penalty for a late filing, and we are not going to add any penalty for late filing now, even with this new regulation. We strongly encourage the brokers to do their best to file within the 60 days that they have, and if they have a late filing, to please put an explanation on that, and we will not be penalizing you if you are late when you file with us.
Okay, next question. Do agents still need to have non-resident licenses in the states that the client has operations in, beyond the home state? And the answer to that is no. You only need your license, whether it's resident or non-resident, in the home state for the purposes, because that's the only one that's regulating. Having said that, you may have a, say, California risk that is or a risk that's headquartered in California, but it may have a different home state like Oregon if all of your exposures are insured in Oregon. So think about that before dropping your non-resident licenses, if you were going to do so.
One of the questions that we've received over and over again is people would like a copy of this webinar, and after it concludes, we will place a copy of the PowerPoint presentation on our website for you to print. The information that you receive in there is directly related to how to do a surplus lines filing, and that portion of it you can also print from our website on our training manual on how to do a filing. And the third piece of that is we will be doing a seminar at the end of August that will review these changes again and how you do a filing with the association. So we have 3 different ways you can get the information that we're trying to get out to our members. And if you have any specific questions about how to do a filing, you can call us or email us.
Troy, we have a question here that asks whether it's correct that 100% of the premium on a multi-state policy where California is the home state is taxed at the California tax rate.
That is correct.
Another question. What about master policies that have multi-state open enrollment? How do you quote the premium since you don't know at the onset where the home state will be based on allocation of premium? You'll recall that the groups only applies to affiliated groups and not to master policies. The master policy, the home state, for the purpose of master policies is determined by the named insured on the master policy. So then you go to your home state rules for that. If the question would probably only apply then if you have named insured on a master policy and there was no exposure within the state, and then it would be problematic, but that seems to be a highly unlikely probability. Hi, I could not get access to the WebEx webinar, and can I access it? We already answered that one.
Okay.
Can I access it from the SLA website instead?
And, to add to that point, for those that came in late to the webinar, if you weren't able to sign on right at 10 o'clock, the webinar was recorded. And so you'll be able to click on the link and listen to the portion that you were unable to hear if you were interrupted in the middle of the presentation. So you'll be able to hear what we said again, and you'll be able to print the slides so you have the information.
We sometimes have project policies for our California clients outside California. For example, there was a recent project in Oregon. We applied for a license in Oregon and followed the filing requirements in Oregon. Does this change with the new rules? The answer to that would be no. If the risk is entirely in Oregon, which seems to be how you described it, then the Oregon law would apply and you would still have needed that license and to follow the Oregon filing requirements.
And that brings us to the point again that determining the home state is very important, and that's the first thing you should think of when you are looking at a surplus lines risk and how you're going to do your state taxes and follow the regulatory rules, the regulations.
Exactly. So can we call the commercial column on the new cover sheet, quote, CI, end quote?
Yes, you can.
How does this apply to D&O, EPL, and E&O, i.e. non-property risks, where there is no premium allocation? The question's not entirely clear because it says how does this apply, but the first point is to use your home state definitions. If you enter into a situation that requires allocation in order to determine the home state, what you need to do is follow the processes that you have been following to date to determine what the state is and be consistent in doing so until California or any other states give specific guidance as to how they expect allocation to be done. But document your file. Where do we find an exact definition of commercial insured?
The new section in the code is section 1760.1B, and that's where you will find the exact definition of what determines if it is a commercial insured.
We attended a webinar hosted by NAPSO earlier in the year. During the webinar, they stated that the NRRA bill did not address policy effective dates, but did address that the law was effective by the date that the tax premium was due to the state. We have a multi-state association with California as the home state, and the policy is effective June 30. Based on what we have been informed and what we read in the bill, we charge California tax and surplus line fee for all locations because the tax was due after July 21st. Do we have to go back and charge the tax for each applicable state? The answer, let me ask, we have Nicole Zayak from Dewey LaBeouf with us, and would you give an idea of how they might handle that situation?
Well, AB 315, the new law and the new requirements was not in effect at the time that this tax apparently was collected and the policy was bound. So that law would not apply. However, you've collected the tax that was due to California and overpaid. In terms of fixing that with vis-a-vis whether tax is owed to other states, that is a question, Jim, that pertains to other state laws and is outside the scope of this presentation. As far as California is concerned, an overpayment is something you may wish to correct, but not legally wrong. And for the other states, you'll want to check and see how they have handled implementation of NRRA, because every state is doing it differently.
Thanks, Nicole.
One of the questions that we've received is in regards to the new D1 and D2 forms. Many of you are already fast and furious on your keyboards and logging onto our website to receive them. And until the law goes into effect, we are not going to have them on our website. So on Thursday, you'll be able to log into the website and get the new D1 and D2 forms. But until the law goes into effect, we do not place forms on our website. I'm sorry. For now, you'll have to just set up a reminder to yourself that on Thursday. And in fact, that brings me to a good point, that on Thursday, there'll be a variety of changes on our website that you will see. The word Leslie will no longer be there. It will now be Lasley. There'll be a new D1, D2 form. There'll be a cover sheet example you can print out. There will be the NRRA Help Center, which will have different forms, and all the information you need in one spot. So I strongly encourage everyone to log into our website on Thursday and advise their filing people to take a look at it as well, because everything will change on that date. Okay. And yesterday, many of you received, if you're on our list, to receive the memos. We did send out the new D1 and D2 in a memo yesterday. You should have received it from Ted Pierce. If you have not received it, you can always email us and make sure that your email address is on file with the SLA to receive those types of notifications.
Another question here. Other than extensions of time that are longer than 90 days, which are considered separate placements under the new law, are the only other endorsements subject to the new law those endorsements that take effect on or after October 18, 2012, including invoicing of installments dated on or after October 18, 2012. And this is with reference to policies issued prior to July 21st, 2011. If you're listening and didn't write that down, you may have lost it, but the answer is yes. If the policies are issued prior to the 21st of July this year, the only questions that we're really dealing with falling under the new law after October next year deal with the extensions and the invoices and other financial transactions. Will a D1 be required for the exempt commercial purchaser, or will the required exempt commercial purchaser notice be signed by the insured be sufficient?
The exempt commercial insured is only exempt from.
Right. I think there's maybe there's a practical answer to this, which is that the standard to be a exempt commercial purchaser, or what they call commercial insured in California, is a higher standard than the standard for an industrial insured.
Correct.
So it would be hard to imagine a commercial insured who didn't also qualify as an industrial insured. The question about D1 deals with industrial insured. So the answer is, from a practical standpoint, the most likely. But you do need to document that they are both a commercial insured and an industrial insured if...
by definition.
Right. This is a good question because a number of the larger brokers are very concerned about this, which is, does premium include all premium, including that which is associated to foreign exposures, as far as California is concerned?
And the answer to that question is yes. So all premium, including premium associated to foreign exposure, is included.
Are there going to be any NRRA rules on purchasing groups, or that specifically pertain to purchasing groups? And the answer, the question that says NRRA rules, and given that the scope of this webinar is California laws and what's in AB 315, we'll answer to that context. As far as California, the answer would be not to our knowledge at this time. A lot of questions coming in.
And we received another question about the new D1 and D2 forms, which is, since they are required after 7/21, how does this change apply to policies with an effective date of 7/21 and thereafter? And I'm assuming that this is in regards to those of you, if you have bound the policy effective 7/21, you may have had your D1 signed prior to the effective date, as you should. And so if the effective date is 7/21 or further, and you've already had a D1 signed, you're wondering if that is going to be okay. And the answer to that is that it is okay. You will be able to use the D1 that you've already had signed, and the policies that are effective or you're working on after 7/21 will require the new D1. I know it gets a little tricky when you have things that are very close to a date where a new regulation goes into effect. And so the key thing there is to apply the same standards across the board in your office. So if you have any questions about that, you can give us a call if it's not clear to you.
So, what happens when you have an insured located in California, but one insured event is taking place in New York? New York NRRA law stipulates that New York is the home state if the insured is located there. Therefore, New York would not accept this filing. So would the home state be California? There are facts in there that you would need to know some additional facts. If, under the policy you're talking about, there is no California risk, then California is not the home state. And actually, New York law would apply, or at least whatever is the home state based upon NRRA determinations, their law would apply, but it would not be California. When you say one insured event is taking place in New York, if you have a event policy and you're making declarations, then and some of those events are in California, then California would be the home state because that's the principal place of business. It goes back to going through the checklist, kind of the items one point at a time, and in most cases it should become fairly clear where the home state is. And in most cases, with very few exceptions, the home state laws are very consistent with what you find in NRRA and in AB 315.
So we received a question about the cover sheet, and I will say many of the brokers already have a cover sheet that they have designed that comes in with their batch filing. And some of you and within your offices may call it something different, a batch sheet, a cover sheet, something of that nature, and you have your own way that you have designed it, your own program that you have programmed to print it. The important thing to note is the cover sheet that you send to our office, and whatever you call it, needs to have the indication if the insured is a commercial insured and the percentage of premium that is allocated to California. And that's going to let us know whether it's a multi-state risk. So if you already have, like many offices do, a sheet that their systems generate that will go on top of anything they send to this office, you can continue to use that sheet. Just make sure you add in those two fields on the sheet. And also, you don't have to have them bookend the information. They can be somewhere along the line of that information. We just wanted you to know we need the information per insured. And we put them on the ends of those lines to emphasize the two issues that we're talking about.
When determining the home state, if there is no exposure in the principal place of business, will California be suggesting an allocation methodology for coverage or type of risk for use by the broker? That's a good question, and the answer is that to date, no methodology has been suggested. So, as far as will be, don't know, but there is none suggested or mandated by California at this point in time. Second question from the same source. Please provide a precise definition of gross premium. Is total California premium defined as U.S. premium, allocated premium only? That's the same question that I think Joya addressed earlier, which is phrasing it a different way. Do we exempt from the total premium subject to the tax that which applies to exposures outside of the United States? And the way AB 315 is worded, it does not provide that exemption. Will GAAP forms in place prior to NRRA still be applicable for post-NRRA transaction? The GAAP question is interesting. The basic GAAP rules are unchanged, so that doesn't change. The only real effect is that you may find that there's even less need for GAAP because there will be at least some insurers that are being used on GAAP currently that will now be eligible because they're on IID quarterly listing, or because they qualify under the new lower eligibility standard, and thus they would no longer be part of GAAP, but they would be eligible insurers. We're reaching the 1 hour mark.
One of the questions we received, again, about the D1 is, will a new D1 be required every year at renewal if the renewal is with the same carrier? And the answer to that is no. The same exemption applies to the D1 and the D2 that were all in effect prior to the regulation going into effect. The only thing that has changed with the D1 and the D2 is that the wording on them is slightly different. A D1 is required for placements other than renewals, so on new business with the, that you keep on file in your office.
Okay, one last question, which actually we have several questions basically asking the same thing, which is, do we expect California to join one of the tax sharing arrangements or compacts, whether it's SLIMPACT or NEMA? And we don't know. At current, the state has taken a wait and see where those go and then make a determination. So, as Joy mentioned earlier in the presentation, we will do our best to keep you advised as we know of any progress with regard to that. But for the time being, California is not a member of a compact and thus is not sharing any of the premium tax, and 100% of the premium is taxed at the California 3% rate.
Well, thank you, Hank, for participating in the webinar. I believe this concludes our presentation. We will have the frequently asked questions portion that will be available to you, so you can review some of the questions if you didn't have a chance to jot down the answers regarding D1, commercial insureds, cover sheets. I'd like to remind everyone that we're going to have a seminar at the end of August that will review how to do a filing again with the Surplus Line Association. It'll be very similar to what you've seen here in this webinar, and we'd love to see if you'd like to come out. We will have a seminar in San Francisco, one in Fresno, and one in Los Angeles. And all of that information is on our website, and I believe that concludes our presentation for today. Thank you.